Hey there, YouTube, is about out here with another Newsday Tuesday. So let's get right into it, shall we? Hit it.
Is America heading towards a recession?
I mean, if you looked up disaster in the dictionary, you'd see Intel's ticker.
The unemployment rate.
So more than about $1 trillion wiped out from the economy over the past couple of days, if I was not wrong, from the stock market. So as I understand, it is recovering. I think it was a temporary setback. So it was a correction that was needed, as I understand.
Jumping to 4.3% is the highest level in nearly 3 years.
The central bank holding interest rates steady yesterday for the 8th straight meeting, opening the door to a September rate cut right before the presidential election.
Major investors are dumping stocks as the NASDAQ officially entered correction territory on Friday.
Yeah, this is true. I think Warren Buffett cleared, $75 billion worth of stocks?
Buffett, for example, just sold roughly half of his entire position in Apple, even after they reported a record quarterly operating profit. We're going to dive into what's causing this major market sell-off, but first, let's take a look at some individual stocks that have been hit the hardest.
I think if I had to pull a guess, I think Nvidia is trading higher than it should be trading at. Yes, AI is important, and yes, AI will become an important tool, but let's be frank, it really isn't technology that's going to be helpful to the common person in this, at least for the next few years. You're paying for the developments that will show up within a decade or so, which would actually bring like massive benefits. So at this stage in time, Nvidia is kind of overvalued in my opinion. Of course, investors may have their different opinions, of course, on it. Intel is having from the last week's, Newsday Tuesday, Intel is having a really bad time with their chips, the 13 gen and 14 gen chips. So there is obviously the problem of losing customer confidence. So hopefully the 15 gen chips either bring like a massive boost in performance or really help alleviate some of those concerns. Otherwise, AMD is just eating up the cake or eating up the pie at this point in time. So I can only call out for two companies. Microsoft is probably doing some weird Microsoft stuff, but I think Microsoft was caught in the crosshairs here. Were they really doing anything else? I mean, yes, the CrowdStrike situation wasn't even their fault. It was a CrowdStrike, the Falcon Sensor's weird update that really caused problems for them. So I'm guessing Microsoft was just caught in the crossfire here, I guess.
First off, we have Intel. This stock had its worst trading day since 1974, with the stock selling off over 26% after reporting earnings. This alone evaporated about $30 billion of value for the tech giant. The first reason behind the sell-off here is layoffs. Intel announced that they would be cutting about 15% of their workforce as part of a $10 billion cost-cutting plan. In addition, Intel admitted that they've been unable to keep up with important trends like artificial intelligence. In the second quarter of 2024, Intel reported a massive $1.6 billion net loss, and that compares to net income of $1.5 billion in the same quarter of last year. Intel stock has been on a nosedive since the end of 2023, and the total loss for the stock from all-time highs now stands at just shy of 58%. And keep in mind, this isn't just some random tech growth stock. Intel is part of the Dow Jones Industrial Average, which are 30 prominent U.S. blue chip stocks that are viewed as industry leaders. If this
I did not know Caterpillar was on that list, but that's good to know.
Continues, this could potentially jeopardize their position in this prestigious index.
They're really good.
Next up, we have Amazon. Amazon stock dumped just shy of 9% on Friday after reporting earnings. This was the biggest single-day drop for Amazon in years, erasing $134 billion in total market value for the e-commerce giant. While there are broader catalysts for this big tech sell-off that we will be covering shortly, Amazon missed revenue estimates for quarter 2 of 2024. Revenue was expected to come in at $148.5 billion, but Amazon ended up reporting revenue of $147.9 billion. But this $600 million revenue shortfall is not what caused this massive sell-off alone, because keep in mind, the stock market is forward-looking. Instead, it was largely due to weak outlook for the third quarter of 2024. For quarter 3, Amazon estimates that revenue will come in between $154 to $158.5 billion, compared to analyst forecasts of $158.43 billion. In addition, operating income is expected to come in between $11.5 billion and $15 billion, compared to estimates of $15.2 billion. While the cloud business beat revenue estimates and earnings per share came in well above the estimates, Wall Street was still solely focused on the forward-looking guidance. From the peak in July, Amazon stock is now down about 16% overall.
I think that is what it is. I understand the obvious assessment that Wall Street is going for, but I think Amazon still has strong forecasts for the next 5 to 6 years. So I don't think it's really like it's a temporary dip. They'll still come back to their peak values for sure. So I think buying the dip here is actually a pretty solid opportunity. Fair enough.
Continuing the trend here,
it's not like anyone's going to stop using Amazon or Amazon Web Services tomorrow. That's not happening. Too much of the internet is too dependent on their services. In effect, they're like the Titanic. They're too big to fail, pretty much, or the big banks.
Sell-off is Microsoft. Microsoft reported solid earnings for the second quarter of 2024 with revenue and earnings per share that beat Wall Street estimates. However, a slight miss in the cloud business, specifically the intelligent cloud segment, led to a sell-off taking place. Okay. Microsoft stock initially sold off 7% after reporting earnings after the bell on Tuesday, but has since recovered slightly. Overall, Microsoft stock is now down 12.5% from the high in July. But this market sell-off is not just limited to big tech stocks. In fact, major U.S. banks took a huge hit on Friday as well. Bank of America stock dropped almost 5% on Friday, bringing the overall drop to 15% from the highs of July. This was partially due to Warren Buffett also selling off billions of dollars worth of Bank of America stock, in addition to Apple stock.
That is actually interesting. I wonder why that would be the case. The only inkling I could find probably, or that I understood, was probably from the past couple of months, there have been people who've been, kind of hinting at higher default rates among credit card loans and other down payments through most American banks from taking higher, more like greater than higher risk like credit lines. So I think that might be one of the reasons. But apart from that, Warren Buffett dumping both Apple and banking stocks is kind of a weird double whammy. It's like, well, there's not enough confidence in both those sectors that warrants the dumping of the stocks. Not sure.
Banking-related sell-off also affected Wells Fargo, which dropped almost 6.5% in Friday's trading session alone. So what is actually causing this major sell-off in U.S. equities? The first and biggest reason behind this major market sell-off is the jobs report that came out on Friday. In July, 114,000 new jobs were added as compared to 179,000 in June and 216,000 the month before that. Overall, job growth came in much lower than expected, and this sparked significant fears of economic slowdown. Over the past 12 months, the average figure for new jobs created monthly has been 215,000. So this July figure of 114,000 new jobs created is roughly half of the average over the last 12 months, potentially indicating a significant slowdown in the labor market. In addition, the overall unemployment rate in July ticked upward to 4.3%, compared to 4.1% in June and 3.7% at the beginning of the year. Unemployment came in at the highest rate since October of 2021, bringing about significant concerns of a broader economic slowdown. And this leads us into the second major reason for the market sell-off, and that is interest rates. With clear indications of economic slowdown present and inflation cooling off, many expected the Federal Reserve would finally cut interest rates at their latest meeting. However, at the latest Fed meeting on Wednesday, interest rates were held steady at the current 23-year high. During this higher interest rate period, the Fed has been pointing to a robust job market as an indication that the economy was strong. But the last 3 months of data points to a potential trend reversal in the job market. Now, many have criticized the Fed in the past for being too slow to respond to the high inflation caused by the pandemic spending. Now, there are many who are concerned that rates have been held too high for too long, forcing an economic slowdown to take place. Inflation is cooling off, with the latest reading being 3% compared to 3.3% in the same period of last year. However, this is still well above the Fed's long-term target of 2% inflation. Now, there was indication that the Fed might cut interest rates as soon as their next meeting in September. This would be a benefit for the overall economy, as it would lower borrowing costs for Americans across the board for things things like credit cards, auto loans, and even mortgages. But right now, the Fed is stuck between a rock and a hard place. If they cut rates too soon, this could cause inflation to reverse its current trend and begin increasing again. But on the other hand, if they wait too long, this could potentially force an economic slowdown to take place and potentially push us into a recession. The next jobs report, as well as CPI report, will be a major catalyst for the stock market, be it a good one or a bad one. Now, the final reason for this major market sell-off ties back in with the big tech stocks, and that is overall AI disappointment.
100%.
Almost every major company out there is trying to jump on the artificial intelligence bandwagon.
100%. I think everyone and their mother wants AI in their machines. It's like, unless you have a chip that doesn't have the word AI in it, they think people won't buy it. It's like the whole new AMD Ryzen chips, which have all those AIs in the name, like nomenclature, which is like, it's pointless. It's like, I mean, I get it. It could be the whole nerdy thing of like, well, most people don't know what AI is. So I think having AI in the chip means it's something different. I mean, I'm not going to get into that discussion. But generally put, most of the TPU, the TOPS performance for most AI-based chips is insignificant. I mean, if you compare it to like an NVIDIA GPU, it's like, which is at least 10 to 20 times faster. It's not really worthwhile having those, neural chips on those machines. And even the tasks they do, they aren't really, relevant at least for the current maybe year or two. You might see more decent developments, I think, in the next coming 5 years at least, but not now for sure. I think most people were ponying up a lot of their money for this new AI tech right now is fueling the development that will come up later on. I think that's pretty straightforward. AI is overhyped and NVIDIA is overpriced for the developments they're bringing in. Same with OpenAI at this stage, as I understand it.
This is resulting in significant spending. NVIDIA has undoubtedly benefited the most from this AI trend, and all of the big tech companies are trying to follow in their footsteps. But this is resulting in billions of dollars being dumped into AI advancements. However, the AI buzz is wearing off for Wall Street, and all of that spending is now being looked at as a hindrance on earnings.
100%. I think I won't say it's the exact same as the dot-com bubble, because I think with the dot-com bubble, it was like you don't really get to see the benefits of the thing you're investing in. It just happened if you have a .com and people just invest in it. But the AI bubble, I think this is still an AI bubble. It really is people investing in it because they think that whatever products that really come out of it might have a particular solution to a market problem that doesn't exist, but now can only be solved because AI is involved. It's a weird situation. And I still think people are overpaying for AI stocks. It's just my opinion. Of course, my opinion doesn't really matter. I think the only thing that matters in a market environment is the general consensus within a population. And if a lot of people, or if enough people believe in the value that's being generated by AI, those prices will go up. I think that much is straightforward. No questions asked.
These investments in artificial intelligence technology won't bear fruit immediately, and investors are losing patience. In addition, the valuation...
Well, to be fair, I think that's more of an investor problem, and I think this is something... I'm sorry for interrupting here, but this is something that's been known for so long. It's like, even with certain companies, it's like for every 10 investors, you know that about 7 investors are basically just there to drop money and then just make really bad decisions. It's just an average number, but generally speaking, you're not going to have a lot of investors who just come and drop money and say, where's my returns in less than 5 to 6 months, which is, that's not the duration mark for an AI investment, at least. I think maybe, and that's assuming those investments work out at all.
For the Magnificent Seven have climbed so high that they've become priced for perfection. And when that happens, a major sell-off is nearly guaranteed when there is even the slightest whiff of bad news. So that's what's happening in the stock market right now. Ultimately, where things go from here comes down to the Federal Reserve, as well as the next jobs report and inflation report. But let me know what you think about this down in the comment section below. If you enjoyed this video, make sure you drop a like, as well as subscribe and hit the bell for future notifications.
I still think that more likely than not, the current situation of the stock market is a temporary scenario. I think it will self-correct. Obviously, the markets needed a correction for how high prices were. But I think the thing that people got to be worried about is whether there actually would be much higher inflation or a significant slowdown in the U.S. economy by the end of the year. I mean, if we make it to at least next year, June or July, you could make the argument you might be, away from the woods of a particular hard crash landing. But as it stands right now, it's 50-50. It can go either way. And looking at how this year is going, I don't really see that as a very optimistic situation. It's just, there are a lot of problems the world is in right now. So it just, you can hope and pray things go out well, but yeah, man, we're living in through some historic wild times right now. I mean, it is insane to say that like there was an assassination attempt like last month on a former U.S. president, and people would just be like, "Yeah, it's a common Tuesday in 2024," which is wild, which is just insane. But if you guys stuck around till the end of the video, thanks for watching. Hope you guys enjoyed the video. Like, comment, subscribe, and I will be back next week with another Newsday Tuesday. Catch you beautiful bastards later. Peace. Take care. Nice.